Hello from me, Jackie Arendse, and welcome to our next video in the series designed to build an awareness of South African tax law. Today I'm going to be talking about how is your foreign income taxed in South Africa. So if you are a resident in South Africa earning foreign income, how is that actually taxed in South Africa? Now, often we overlook the fact that foreign income may be taxed in South Africa. But if we think about it, the South African tax system is a residence-based tax system. It has been so since 2001. That means that if you are a tax resident, and if you're not sure about whether you're a tax resident, go back and look at the previous video where I spoke about, are you a tax resident of South Africa, okay? But if you are a tax resident in South Africa, then you're going to be taxed in South Africa on your worldwide income. So income coming from anywhere in the world is potentially going to be taxed in South Africa. There is some relief, all right? So there are some exemptions, and there's some also relief if you've paid foreign tax and you also get taxed in South Africa, then you could get a relief for the foreign tax that has been paid. But initially, you need to think about the fact that worldwide income is taxed in South Africa. If you're a non-resident, well, then it's slightly different. Totally different actually, because a non-resident is taxed in South Africa but only on SA source income. When we talk about SA source income, we're talking about income that arises in South Africa. For example, if you're a non-resident but you own property in South Africa that you rent out, that rental arises in South Africa. So it's SA source, you'd be taxed in South Africa. Similarly with interest, all right, if you've got deposits in South Africa and you earn interest, that interest is from a South African source. Potentially you would be taxed here. Also dividends on South African shares is arising from a South African source. Okay, so when we talk about SA source income, that's what is relevant as far as a non-resident is concerned. We're not really going to cover that in this video because what I really want to focus on is residence. If you're a tax resident in South Africa, how do you get taxed on your foreign income? Now, resident, as I say, we did a whole video on this, but just to recap for the purposes of what we're talking about here, if you're an individual, you are a tax resident if you're either ordinarily resident here, and that's your state of mind, is this your real or permanent home, or if you're not ordinarily resident, in other words, you know, you've always lived somewhere else, but you happen to spend a certain amount of time in South Africa. If you spend more than a certain minimum amount of time over a 5-year period, you could become resident due to the physical presence test. Okay, and that could bring you in to the net of being a resident. So if you're a resident under either one of those rules, bearing in mind that excluded is somebody who's deemed to be exclusively a resident of another country under the provisions of a double tax agreement. All right, so if you're ordinarily resident here, but you're working in the UK and the DTA between South Africa and the UK deems you to be exclusively a resident in the UK, then you're no longer tax resident here. All right, so these are all the complications that come into whether you are a resident or not. So when we're talking about whether you're a resident, tax resident, it always comes back to this definition in Section 1 of the Income Tax Act. Now, if you are a tax resident, as I mentioned, because South Africa has a worldwide tax system, you're taxed on your worldwide income. So income coming from anywhere in the world potentially comes into your gross income. Gross income is like the open point of the funnel, if you like. That's the starting point of our tax calculation. So your worldwide income comes into gross income. Yes, there might be provisions of a double tax agreement that intervene, because sometimes a double tax agreement will say that certain income that has arisen elsewhere is taxed only in the other country, all right? If that is the case, then we're not going to get taxed on that here. But apart from any intervention from a double tax agreement, the point of default is that if you are a resident here, you need to think about your worldwide income, and potentially that is what you're going to get taxed on. But there are some exemptions in Section 10, which we'll come to. For example, dividends. There's also certain exemptions for interest, although be careful because it only applies to certain types of interest. But there are exemptions and also pensions and so on. All right. There's also credits and deductions, and this speaks specifically to where you've been subject to tax on income in another country and also in South Africa. So now potentially you're getting taxed in both countries. 6 Quat of the Income Tax Act provides relief in certain circumstances for foreign taxes paid by a resident on income that is also being taxed in South Africa. It's an extremely complex provision, but it's worth noting that it does give some relief for foreign taxes paid. Now, if you're a South African resident and you've earned foreign income, whether it be foreign remuneration, interest, rental, dividends, you've got to translate that foreign amount, whether it's euros, US dollars, whatever, into rands, right? So the starting point is, how do you do that translation? Now, we've got rules again in the Income Tax Act, Section 25D, that says for individuals and non-trading trusts, you have the option. You can choose either the average exchange rate for the year of assessment, and that is something that's published by SARS from time to time for any particular year of assessment. They'll say for these various currencies, this was the average exchange rate for that year. Or you use the exact spot rate on the date that the amount was received, accrued, or if it's expenditure, the date that the expenditure was incurred. All right, so you, as an individual, you can use one or the other, average or spot, but you have to use that consistently. So if you decide you're going to use spot rate, you've got to use that for all of your transactions, except, again, certain complications, that there are special translation rules that apply in certain cases, like the Section 6 Quat rebate or deduction. That always talks to your average exchange rate. And there's also special rules that come in for capital gains tax, paragraph 43 of the 8th schedule. All right, so there are some special rules that apply, but apart from that, you have the choice, average or spot, but it has to be used consistently apart from where those special rules kick in. Now, let's just think about the various types of income that you might earn as a resident. You might earn foreign interest, foreign dividends, foreign rental, foreign employment income. You might even carry on a business offshore. All right. And then there's also, and we won't get into this today, but there's the possibility of net income from a controlled foreign company. So as a resident, you may own shares in a foreign company that is regarded as being a controlled foreign company. And then we've got this anti-avoidance provision that causes you as the shareholder to be taxed on the income of that foreign company as and when the income is earned. So it creates a bit of a flow-through rule. But it's quite complex. We're not going to get into that in this video. We're just going to talk to these other main types, and I'm not even going to get into offshore businesses, okay? Because that's a subject all on its own. So we're going to talk about these other 4 main types of income, starting with foreign interest. So if you've put money overseas with exchange control approval and you're earning interest on that money, or you've lent money, that foreign interest, remember, as a resident, you're taxed on worldwide income, and so that foreign interest has to be converted to rands, and that will be included in gross income and potentially subject to tax. There's no specific exemption that applies. I spoke about interest exemptions earlier, but I said it only applies to certain types of interest. And in fact, your interest exemption, we've got an interest exemption that applies to non-residents, all right? But here I'm talking about residents earning foreign interest, so that doesn't come in. And then there's what we used to call the basic interest exemption. Now we call it the local interest exemption. That's that fixed amount of 23,800 or 34,500 per year, but that only applies to SA source interest. So it doesn't apply to foreign interest. So if you're a resident earning foreign interest, you're going to get taxed on the whole amount of that interest. Of course, you would have to look at the double tax agreement between South Africa and the country where the interest is arising. The rules do change. For example, if the South African UK double tax agreement says that when you look at interest, where is interest going to be taxed? Interest arising in one country and the resident is in the other country. So we talk about interest arising in the UK but accruing to a South African tax resident. The double tax agreement says that interest is taxed only in the country of residence. All right, so if I've got a person who's resident in South Africa, it's going to be taxed here, unless it's connected to a permanent establishment in the source country, in my example, in the UK. But if you've just got a South African resident who invests into the UK, takes up deposits, that interest is going to be taxed only in South Africa, not in the UK. However, if you look at another one like the South African-Mauritius double tax agreement, there it says that the interest could be taxed in both countries. They both have taxing rights. So it may be taxed in both the source and the residence country. All right, but the tax is capped in the source country. So that would come through by way of a withholding tax. So if you've got a South African resident who invests money in Mauritius and that pays interest to the resident in South Africa, that's going to be subject to a withholding tax in Mauritius. So it's going to be taxed in Mauritius and possibly also taxed in South Africa, but it's going to be subject to a withholding tax in Mauritius that's capped at a certain rate, and this is going to be 10% in this case. All right, but potentially taxed in both countries. And so then you would have to look at the 6-quart rebate to get relief for the foreign tax paid. So the South African resident would have to claim that rebate in their tax return to get relief for the foreign tax that has been paid there. Foreign dividends, all right, so you invest in companies outside South Africa. Here we've got very specific rules that apply for foreign dividends. So foreign dividends received or accrued to a resident will be taxed in South Africa. It's included in gross income. Then you look at the exemption, and there's a possible exemption under Section 10 capital B. And actually there's two parts. 10B2 talks about a full exemption in certain circumstances. 10B3 talks about a partial exemption. So if you don't qualify for a full exemption, then you get the partial exemption, which is basically calculated 25 over 45 times the amount of the foreign dividend. So you bring in the full foreign dividend into gross income, you get this partial exemption, and you taxed on the balance. Now the full exemption, and I'll come back to the DTA provision just now, the full exemption applies in terms of Section 10B2 in one of these 5 circumstances. So if you hold at least 10% of the foreign company's shares or voting rights, or second one, dividends received by one company from a foreign company resident in the same country, all right? Third one is where foreign dividends declared by a CFC, the controlled foreign company, out of profits already taxed through the CFC rules of Section 9D. You can see this gets fairly complex. Another one, which is a little simpler, is where you've got cash foreign dividends declared by a foreign company that is what we call dual listed. For example, you've got a number of companies listed on the JSE that are also listed on other stock exchanges, like the London Stock Exchange, all right? So if you've got a company that is dual listed, so it's listed on the London Stock Exchange, also listed on the JSE, and now you get dividends from this, like Investec PLC, all right? It's a London-based company listed on both the London and the Johannesburg Stock Exchange. There, your foreign dividends would be fully exempt, all right? And if you get in specie, so this is where there's an asset that is distributed as opposed to cash, foreign dividends declared by a foreign company that is dual listed, if it's there, it will be fully exempt if you've got an in specie dividend going to a South African resident company. All right. The two most common ones are where you hold at least 10% of the shares, or you've got this dual listed company. All right. So as a South African investor, in those circumstances, that's typically where you'd see that you'd get a full exemption for your foreign dividend. Now, remember that we said if you don't get a full exemption, then your dividend is going to be subject to the partial exemption. But I guess we should first have spoken about the DTA taxing rights, because before you're going to bring that dividend into your gross income, you do need to look in terms of the double tax agreement where that dividend would be taxed, all right? Now, it may be taxed in both the country of residence and the source country, the country where the company paying the dividend is based. It depends on the wording of the double tax agreement. But if it's taxed in both countries, similar to what we saw with interest, the dividend that's flowing from a company in another country like the UK or Mauritius, all right, there will be a dividend withholding tax, and that will be capped at a certain rate. So, for example, if we look at the South African UK double tax agreement, dividends paid by a company which is a resident of a contracting state to a resident in the other state. So let's say a company in the UK paid to a resident in South Africa may be taxed in that other state. Now, where it says may, it means it could be taxed in both the source country and the residence country. However, such dividends may also be taxed in the contracting state where the company is based, all right? But then, when we have this potential double tax, the withholding tax that applies in the UK will be capped at this certain amount. All right, so it depends on your holding in the company. 5% if you hold at least 10% of the shares, 15%, etc. Okay, so you could have a withholding tax that applies in the UK, capped at a certain rate. From a South African perspective, you are going to include that foreign dividend in gross income, and you're going to establish whether you get a full exemption or a partial exemption. If you get a full exemption, well, that's the end of the story, and whatever tax you paid in the other country, that is left as it is. If you get a partial exemption, then you would get some relief through the 6-quart rebate, and you have to do a calculation to see how much credit you can actually get for the foreign withholding taxes that have been paid on the dividend that is also taxed in South Africa. Now, with foreign rental, here we're talking about a resident who owns property in another country and earns rental from that country. Again, because this person is resident in South Africa, they're going to be potentially taxed on that rental here. They have to include the rental in gross income. There's no specific exemptions. They might get certain deductions. You have to look at the general deduction formula and your special allowances. There might be some deductions that apply. You also have to think about if you make a loss from this rental. I mean, maybe you've got a bond, you're paying interest on the bond, and your interest is more than the rental that you are actually getting. So you're actually making a loss on this rental. So what you'd have to do there is the full amount of rental comes into the gross income. You claim your deductions, for example, your bond interest, and then you end up with a loss. But here, this loss has arisen from a trade carried on outside South Africa. And so you can't set that off against other taxable income in South Africa. It gets ring-fenced. And then there's also Section 20A, which is a ring-fencing provision that applies to individuals who are in the maximum marginal tax bracket. So that foreign rental, if you're making a profit on the rental, then that would be taxed in South Africa. If you look at the double tax agreement, which allocates taxing rights, generally those rentals could be taxed in both countries. For example, the SA Portugal, if you own this property in Portugal, it says income derived by a resident of a contracting state from immovable property in the other state, all right? So you're resident in South Africa, you're getting your rental from property in Portugal, it says may be taxed in that other state. Remember, may means that it could be taxed in both, all right? So it could be taxed both in Portugal and in South Africa. And if that is the situation, then again, you would have to declare this income in South Africa, and you would then look at whether you could get a 6-quart rebate for the taxes that you may have paid in the other country on this rental that is also now being taxed in South Africa. Of course, the big one is employment income. So South African residents often go and work outside South Africa and they earn foreign employment income. Worldwide basis, that foreign employment income must be included in your gross income in South Africa. If you look at the double tax agreement, does that intervene? Does it change that story? Well, it might. So you always have to look at the double tax agreement because it depends what kind of income you're earning and which country you are working in. Because the country you're working in, where that remuneration income is originating from, that would tell you which double tax agreement you're going to be looking at. And you have to establish what does the double tax agreement say about that type of remuneration that you are earning. All right, sometimes they give sole taxing rights to one country. For example, if you look at the South African UAE double tax agreement, it says this, it says remuneration derived in respect of employment exercised aboard a ship or aircraft operated in international traffic by an enterprise of a contracting state shall be taxable only in that state. You see the wording there? It didn't say may, it says only in that state. So you've got a South African resident who goes and works aboard an aircraft that works in international air traffic, but it's that aircraft is owned by a company which is based in the UAE. What this is saying is that remuneration will only be taxed in the UAE and it won't be taxed in South Africa. All right, so here is an example of where the remuneration would not come into gross income. It's not taxed here. All right, but if it is remuneration that is not subject to a sole taxing right in the other country, then it would be subject to tax in South Africa unless you get a specific exemption. And there are some exemptions that apply. In section 1010, there's actually 3 different exemptions that we'll look at. And then also with remuneration, don't forget pension annuities. That's a type of remuneration. And there's certain exemptions that apply around pension annuities. Although it looks like they're going to be changing this provision. It's one of the proposals in this year's budget speech. That remains to be seen. But there is some exemption that applies with foreign pensions. But let's just have a look at foreign employment income. So I gave you the example of the UAE double tax agreement. Let's look at another one, the UK South Africa double tax agreement. In Article 14, it talks about income from employment. It does say other than directors' fees, etc., which are covered in specific articles. Salaries, wages, and other similar remuneration derived by a resident of, let's say, South Africa, in respect of employment, shall be taxable only in that state, the state of residence. But unless the employment is exercised in the other contracting state. And if the employment is exercised in the other contracting state, then that remuneration may be taxed in that other state. So we're saying if you're resident in South Africa, working in the UK, that income could be taxed in both countries. All right, and this is where the complication comes in. So you would have to disclose that remuneration in your South African gross income, all right, if you're a resident. Then you would have to have a look to see whether you qualify for any particular exemption, like your Section 10102 exemption. If not, well, then the remuneration is going to be taxed in South Africa, could also be taxed in the UK, and that ends up with a situation with potential double tax, and then you'd have to try and see if you could get a 6-quart rebate to give you relief for the foreign tax that you have paid on that remuneration. But let's come back to these exemptions on foreign employment income, all right? Section 10101 talks about remuneration earned by an officer or crew of a ship engaged in international transportation. Officer or a crew member of a ship engaged in international transportation. That gives a full exemption for remuneration earned by that person. There is more explanation in the SARS interpretation note number 34. 10101A talks about remuneration for an officer or crew member of a ship registered under Section 12Q. That's a South African ship operating in international shipping that is eligible for certain tax concessions. And so somebody working on such a ship would have their remuneration fully exempt. Okay, but so there's no restriction around number of days there, but there is a restriction around what kind of remuneration you're earning. It must be that it's for work done on a ship engaged in international shipping or fishing. Section 10102 is a more general exemption. It doesn't matter what kind of remuneration you earn, but it has very strict timelines that apply. So it's remuneration up to 1.25 million rand, earned while outside South Africa, if you are outside South Africa for more than 183 days over a 12-month period, which cuts into your current year of assessment, and that must include more than 60 days continuous period of absence. So there's very specific timelines there. You have to be out of South Africa for more than 183 days, of which 60 days must be a continuous period of absence. Then the remuneration earned while you are outside South Africa could qualify for this exemption, but the exemption only applies up to 1.25 million rand. If you earn 2 million rand, then the other 750,000 could be taxed here in South Africa. So it's quite a complex exemption. Have a look at the SARS interpretation note number 16 if you want more information on that. Okay, but it does mean, and it's specifically geared for the situation where if you're working in the UK, you've been there for more than 183 days, now you're getting taxed there, but you're still tax resident in South Africa, so potentially you're getting taxed here as well. So South Africa gives this exemption, but you must exceed the 183-day absence, and there must be a 60-day continuous period of absence, right? And there's that 1.25 million limit on the exemption. So that can give some relief. As I say, it might be that you earn more than that 1.25, or maybe you don't qualify for this exemption. Then that remuneration is taxed in both the UK and South Africa, and then you'd have to look at a 6-quart rebate and see to what extent you get some relief for the foreign tax that is paid on that income, which is also taxed in South Africa. All right, so the kinds of remuneration that qualify for that exemption, it talks about salaries, leave pay, wage, overtime, bonus, gratuities, etc. But a stipend is not covered. All right. Amounts contemplated in paragraph 1, which talks about fringe benefits, okay? Allowances referred to in section 8, travel allowances, advances, etc. And then amounts through share schemes, 8B and 8C. So that all comes under this banner of remuneration, which could potentially qualify. But notice here, it talks about remuneration. It doesn't talk about income earned as an independent contractor. So if you're carrying on your own business in the other country, then you're not going to qualify for this exemption, all right? If it's your own business as a sole trader, you're not going to qualify for this exemption because that's not remuneration that you're earning, that's business profits. And that comes into a whole different question as far as the international tax treatment is concerned. All right, so another point is that this foreign employment exemption does not apply to services rendered on behalf of the government. All right, so you might be employed by the South African government, you're sent to work for an overseas embassy, and so you're outside of South Africa for a certain period of time, you're not going to get this exemption. It does not apply in that situation, all right? And or to a person holding public office to which the person was appointed, that's someone like a judge and so on. They are not going to get this exemption. All right, so you've got to be careful about the foreign employment exemption. It has very specific criteria. It applies to specific remuneration, and in some cases, it doesn't apply. So be careful about that. I hope this has given you some guidance around how your foreign income could be taxed in South Africa if you are a resident. You can see it does get very complex. So I do think it's a very good idea to make use of a qualified and registered tax practitioner to assist you if you have international income that you are considering, that you're actually earning, and that you need to declare to SARS for tax purposes. I hope this has been useful. Thanks for watching. Do like and subscribe and look out for our future videos. Thanks then. Bye-bye.